Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook and be your host for about the next 15 minutes here. I don't have too much to work on today as we head into the weekend. I'm going to look at a trade in United Health Group, the symbol UNH, and we're going to use that as a surrogate. Now, we did an SPX trade, and there has been a little bit of an issue in the derived value of the SPX, but the bottom line is the trade that we did on Wednesday was perfect. I don't know if I mean, it's hard for me to say that because it never happens in the options world. But what we got bearish, the market went down and it stayed down for most of the day, almost instantly after the show. And then it came back and closed very close to our middle strike of our open wing butterfly. And the opened part was to the downside. So that got me thinking just a little bit. And I just kind of want to summarize this is that here's the benefit of the open wing is that I have the general rule that if I'm going to do a trade in zero DTE that we would normally get out between 2 and 3 o'clock, right? As soon as we possibly can. If we're profitable within that range, we want to get out. If it goes outside of our wings, we want to close it because the last hour and a half, 2 hours of the market, gamma and delta take over, and theta is not as big of a driver. So it becomes more about price movement than it does about theta decay. Now, obviously, price movement always matters, right? But at the beginning of the day on a zero DTE options, time is very present. So, for example, we're going to look at a UNH trade today, and I kind of stumbled into the Friday UNH butterflies mainly because they were announcing on a Thursday and then I decided to do a Friday trade, and then I realized that with UNH at this point in time you have some volatility and some predictability. For a while it was still sticking around that 40% implied volatility, a little sticky right in that range, but normal right now it's actually staying around the 30% range. And in the short term, I actually see a fairly high IV. Okay, so the moral to the story is at the money option contract is trading for $8, $9. And that's at the money. That's no intrinsic value at all. And that $8 or $9 has to go away by the end of the day. So if you're looking at doing zero DTE trades and you open that wing, the market went down and you're profitable on the way down, but there's no real reason to get out of the trade because if the market comes back, you can close it at even a higher price later on. And if you did that and you applied that to Wednesday's zero DTE SPX trade, well, you did okay. Right, you did well. It was a home run, and it's a cash settled index in the SPX, and that's also a big thing because there's no exercise and assignment of the stock or whatever. Either cash goes into your account or cash comes out of your account, and it's that simple when you're looking at an SPX trade. So it makes it a little bit harder if you're going to try to do just a Friday trade in an underlying stock, or if you're looking at just anything like the SPY. The SPY is settled in the stock, very liquid underlying, but it's hard. It's just not as carefree as doing an SPX trade because of the cash settlement. So today, I think I'm looking at the UNH trade, and I'm gonna go out 1 week. It won't be a zero DTE trade, and let's run and let's look at the option chains right now. The zero DTE, we just don't have a ton of premium in that option contract, but on the September 12th expiration, we have 7 days remaining, And I still want to get positive on UNH. Insider trading has been fairly large. The CEO, a lot of top officials have been buying the stock. Warren Buffett wanted to take a position on the stock. So I do want to do a short-term trade, and I do want to get bullish on UNH. And I still, like I said, the vol's been sticky. The historical vol's around 33%, and we're seeing implied vols going all the way out to October is in the 30% range. Now, part of my issue is we're in September and October, and I don't really want to just get long things. I don't mind putting on a few trades, but I'd like the volatility to come out of the marketplace before I want to really get bullish. And I'm always nervous about September and October. Maybe I shouldn't be. Maybe I'm part of the problem, right? Because I always feel we always do VIX trades in September and October, and we always just always worry about volatility. So we're going to do a very simple trade today in UNH. We're going to do an open wing butterfly. We're going to give ourselves a lot of good upside potential by doing this position, and we're not going to put a ton of risk inside the trade. So I'm going to lean bullish, and I'm going to start by buying the 310 strike call, but I'm going to go out to I'm going to go up 15 points. Well, and then let's go down one. Let's go down to the 3. Let's go down. I don't think I want to do the. Let's do the 310. Okay, we're going to do the 310. We're going to sell the 325, which is right at one standard deviation, but it's showing me a 25 delta. So the one standard deviation move is more up towards the 330 level. So I feel better about that. We're going to sell 2 of these. Gotta get rid of this. And I just like UNH in general. I actually own UNH in my account. I jumped on the Warren Buffett bandwagon also. We're going to sell 2 of these and buy 1. But I was actually thinking about it just because of what I saw on the insider trading situation, and the stock had just been getting so beat up. So trying to catch a falling knife is what the UNH play is to me. The markets are scary at this point in time. I had some free capital. I actually bought some shares of it. And I like the bullish trend to continue, and I want to place a trade that will give me a little bit of downside protection. So the market can come down a little bit, and we're going to be okay. 310 is when we lose the maximum that's on that trade. But all we need the market to get to is 310 plus 529. And this is one of the beautiful things about the open wing butterfly is you can give yourself some more upside, and you can get your break even fairly close to where the underlying stock price is at, right? So 310 plus 529 is 315.29, and the market right now is at 314.45. So you're just buying a smidge of time premium here on this trade. And if we can stay above either where we're at or go above that 315.29 level, well, then we're break even on the trade if we ride it all the way to the expiration date. Now, if it happens to get a little bit of a move sooner, well, heck, then we're obviously going to get paid sooner on the trade. We're going to be selling 2 of the 325s. We're still bringing in, like I'm saying, we're getting still a ton of premium. We're doing this with 7 days. We're paying 8 for this. We're receiving 2 for this. And a lot has to do with the fact that we have decent volatility. I liked it a lot better when it was hanging around the 40% vol right after earnings, not before earnings. It was actually trading at that vol. Now it's still fine. It's at around 30. That's not bad. On a $300 stock, you get some premium for it. So we're going to buy the 310, sell 2 of the 325s, and buy 1 of the 330s. If we take this and we send this to the what if calculator, and we look at this trade, we see that we still like time decay. Come on down. There we go. We still like the time decay, right? We're still selling 2 of these option contracts, but we're giving ourselves, we're putting our break even right about here. 315.26. That's where we're crossing this x-axis right about here. And from this point on up, we're profitable. To start with, this is the profit and loss graph, and this looks accurate to me. Pretty solid throughout. So you have about a week before you really start getting nervous if the market moves to the downside. Time premium is your friend, right? So not a week. You have until Monday or Tuesday. This is a 1 week trade. I don't know what I'm talking about. You have a few days before this line starts drifting in towards your downside. So the reason why I like this scenario is that we're selling the premium, and it goes all the way back to the 0 DTE conversation that we just had. Let's pull out for just a second. So if we look at the 0 DTE, we always want to get the trade on at the beginning of the show, because we've mentioned many times in our SPX 0 DTE open wing butterflies that we've been doing that a half hour matters in the SPX. This is also the case when you're looking here at this type of trade in the UNH. We're doing the open wing, we're doing the calls, we're getting bullish. But you have that time premium that you're selling that you need to decay if you're right, allows you to get out early if you're wrong at a minimal loss. And that's what the profit and loss graph is showing us, in that if the market comes down, we get on Monday or Tuesday, if we look at this and the upside momentum doesn't continue, we can close out the trade and move on. And that's the way that I would approach this trade. We have 3 legs on it. I do have an adjustment for butterflies where you can roll into a spread. But on this scenario, if we come back on Monday or Tuesday and all of a sudden we see some weakness in the stock, all we got to do is just close it out. And we're putting 529 into it. We could say to ourselves, well, we're going to get out if it's trading for 3. And that's a very good possibility, unless the market just tanks. And the UNH, can get blindsided by news, which is part of the reason why the volatility has came up, is because it's been in the news recently. It's kind of mitigating a little bit, but Warren Buffett was, at Berkshire Hathaway, I should say. He's retired now. About time. I'm glad he invested well so that he could retire at the spry age of 91 years old. But with that said, I like this trade. That's simple. I like the trade. I like the setup. I like the way it works. I like giving yourself, shooting for a spot where you just need a minimal move and you can break even on it. And that helps a lot by just doing the open wing butterfly as opposed to just buying the call spread. Okay, let's go back to the trade. I had some more time today, so I wanted to get into that a little bit. So this will be the paper trade, and I will, it's already in the trade ticket. So let's go back over here. Here's the setup. Here it is. We are looking to go out to the September 12th expiration, 7 days away. We're going to go a little bit in the money and buy the 310 strike call, sell 2 right at the 25 delta. Right at the 25 delta, we're selling 2 of the 325 strike calls, which is giving it about a 25% chance of it reaching that strike. And then we're going to stop short. So this is 15 points wide. We're going to buy the 303 strike call option. And that gives us 10 points. If the market goes above 330, this butterfly will trade close to $10 at expiration. We paid $5.29 for it. So now we got about a 50-50 bet in that if it does go above 330, we can make $4.70 if I round up a penny, $4.70. Maximum we can lose is $5.29. But if we come back on Monday and the market starts drifting towards the 310 level, it's going to keep some value, at least Monday or Tuesday, and we would just get out of the trade. We'd show the weakness in the stock, just get out of the trade. We'll have a show on Monday. We'll talk about it on Monday. But if it continues on up, time decay will be our friend. And if it blows through the strikes, that's all right. And that's what happened with us in the SPX Butterfly on Wednesday. It blew through the strikes and then came back, which was great, because if it comes back, then we have a potential to make an extra $10 on the trade. The maximum, well, we'd be able to, the maximum it could trade for is 15 minus the 529. And so you're looking at $9.70. That would be the maximum if it stopped right at 325. Now, the downside of looking at UNH and setting up this trade versus the SPX is that it's not cash settled. So you're going to want to close it out. You don't want to wake up and have one leg in the money, right? So here's where the risk comes in on the cash settled versus the stock settled, right? You fall asleep. You put this trade on Friday, September 12th goes away, and you wake up and the stock's trading at 320, right? 10 points in the money. Well, you're going to get exercised and you're going to buy the stock because these are going to expire worthless. You're going to own the stock. You're going to be up $10 on the stock, but that means you're going to have to put up the capital to buy the stock. Now, you can do that. The brokerage firm isn't going to slap your hand. They might not be happy about it. But if you get assigned on a Friday, you can sell it out on Monday morning and you'll be okay. But it creates an issue. You have to buy 100 shares of UNH at $310. So I like the cash settled indexes, especially on shorter term trades. And that's it. No questions. And I'm assuming no questions because I did a great job of explaining everything, right? Well, that's it for this edition of Options Guy TV. We'll be back on Monday. We'll take a peek at this UNH trade, and then we'll explore a few more trades that we can look at on a shorter term basis. I want to stick in the shorter term basis here over the month of September. Have a good weekend.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.